All right, welcome to Iron Financial. This is the show where we help you forge a stronger portfolio, and we do that by putting the market's biggest names through a serious stress test. Today, we've got a giant in our sights, Thermo Fisher Scientific. The ticker is TMO. Now, this company is an absolute cornerstone of the global scientific community, a real titan. But as you know, a strong reputation doesn't automatically mean it's a strong stock. And that's exactly what we're here to find out. We're going to tear down their latest financial reports, we're going to inspect the load-bearing walls, and we're going to see if this company's foundation is as solid as it looks on the surface.
Okay, so let's just get right into it. When you're looking at a company of this size, with this kind of scale, the very first question has to be about durability, right? Is this a financial fortress that you can actually build a piece of your portfolio around for the long haul? On the surface, the numbers suggest it is. It's a leader, a name that's basically synonymous with scientific innovation. This thing should be a bedrock investment.
Whoa, hold on. Fortress is a really strong word. I've seen a lot of impressive-looking buildings in my time that turned out to be nothing more than a fancy facade. What we need to figure out today is whether that strength is real, if it's sustainable, or if it's just some clever financial architecture designed to look good from a distance. That's really the core question, isn't it? Are we looking at solid granite here, or is this just some well-painted drywall that'll crumble under the first bit of pressure?
To understand the structure, you have to look at the blueprint. And believe me, Thermo Fisher's blueprint is massive. This isn't some little niche player we're talking about. They are, and this is their own term, the world leader in serving science. We're talking about a company with annual revenues clearing over $40 billion. They make the instruments, the software, the services, even the little plastic tubes that scientists use every single day in labs all over the world. From a university research lab to the biggest pharma companies, if you're doing serious science, odds are you're a Thermo Fisher customer. In their space, they are the undisputed heavyweight champion.
And this right here perfectly illustrates their market position. Just look at their mission statement. It's incredibly powerful. See, they're not just selling widgets. They are literally enabling progress in medicine, in clean energy, in public safety. That kind of mission embeds them deep within their customer base, creating what they call a trusted partner status. And that is something that's incredibly difficult for a competitor to replicate. It's a wide moat, and it's dug deep, and it's filled with crocodiles.
It's a great mission. I'm sure it looks fantastic printed on the first page of an annual report, but you and I both know a noble mission doesn't pay the bills, and it certainly doesn't guarantee returns for shareholders. So let's not get distracted by the marketing pitch, okay? Our job here is to test the financial reality, not the corporate philosophy. So, is the business as healthy, clean, and safe as the world they claim they're building? Let's see the numbers.
All right, he's right. Enough of the philosophy. Every fortress, every single one, is built on a foundation. And in the world of finance, that foundation is revenue. Top-line growth, that tells you if the business is actually expanding or if it's starting to contract. So let's start digging and see if we can find any cracks. We are unpacking their most recent numbers, hot off the press from the first quarter of 2026, to see what is really driving this machine. This is the first and maybe the most crucial test of its strength.
And right out of the gate, the headline number looks solid, really solid. For Q1 2026, revenue came in at over $11 billion. That's a 6% year-over-year growth. Now, in what the CEO himself calls a more uncertain macroeconomic environment, getting 6% growth for a company of this massive size, well, that's pretty respectable. It suggests they've got forward momentum, that they're executing well. This is the kind of number that builds confidence on Wall Street. It's clean, it's positive, and it meets expectations.
Confidence? Or is it confusion? Look, that 6% number is what we call reported growth. But I think everyone watching knows that not all growth is created equal, right? You can grow a business by actually building it, or you can grow it by just going out and buying it. So before you start celebrating that 6%, you need to tell me how much of that growth was organic. Let's get a clear definition up on the screen. See, organic growth shows you how the core underlying business is actually performing. It strips out all the noise from buying other companies and from currency fluctuations. So, what's the real number? The number that shows the health of the business that actually operate day in and day out.
Okay, fine. So this is the crucial point. When you strip everything else away, all the noise, the organic revenue growth for Q1 2026 was 1%. This reflects the core operational performance of their existing business lines, navigating that tough economic environment we mentioned. 1%. Let's just let that sink in for a second. The headline they're screaming is 6%, but the actual growth of the business they already owned was just 1%. That's not a fortress, my friend. That's a fresh coat of paint on a creaky old building. To me, that single number is a massive red flag. It suggests the core engine isn't roaring ahead. It's barely idling.
It's the difference between a healthy athlete running a marathon and someone walking on a treadmill on life support.
Now, hold on, because what's really interesting here is how all the pieces fit together to get to that 6% number. Yeah, organic was 1%, but look at this. Acquisitions contributed a full 3 percentage points to that growth, and favorable currency translation tacked on another 2%. So my take is that this is a multi-pronged growth strategy in action. You see, management is using its powerful balance sheet to strategically bolt on new capabilities and revenue streams, while the core business weathers the economic storm. It's smart capital allocation.
Oh, I see a different story. I see a company that had to go out and spend a ton of money on acquisitions just to generate the majority of its growth. The heavy lifting here isn't being done by the business itself. It's being done by the mergers and acquisitions department. They're buying growth because it looks like they can't build it internally anymore. And that is a much riskier and often way more expensive way to run a company. It's a treadmill. You have to keep buying more and more companies just to keep your growth numbers from going negative.
And look, this isn't a one-time thing. This is not an anomaly. Let's just zoom out and look at the history here, because context is everything. On this slide, you can see the annual organic growth numbers for the last 3 full years. In 2023, it was negative 5%. Then in 2024, it was totally flat, 0% growth. In 2025, they managed a meager 2%. And now here we are with 1% in the first quarter of 2026. This isn't a trend. It's a clear pattern of stagnation. For years now, the core business has been going basically nowhere. This just reinforces my point. The reliance on acquisitions isn't some brilliant strategy. It's a necessity. It's what they have to do to mask a fundamental weakness in the company's foundation.
Okay. Revenue is only part of the equation. You know that. A business has to be profitable. So let's move down the income statement and talk about what the company actually keeps. And this is where we get into the profitability puzzle. The often debated difference between the official, by-the-book, GAAP accounting, and the company's preferred adjusted reality. This is where the real stress test begins, because this is where companies can tell 2 very, very different stories using the exact same set of facts.
Management and any bull on the stock will point you directly to this slide. In Q1 2026, they delivered an adjusted earnings per share of $5.44. That is a strong number. It's up 6% from last year, and it is the figure that Wall Street tends to focus on. It shows the company is generating significant profits on a per-share basis, which at the end of the day is what shareholders ultimately care about. Well, of course they'll point you to that number. It's the bigger one, it's the prettier one. But just look to the left. The official, legally mandated accounting number, the GAAP EPS, is only $4.43. That is more than a full dollar per share lower. That's a huge gap. Anytime I see a chasm that wide between the adjusted fairy tale and the GAAP reality, my alarm bells start ringing off the hook. This isn't just a minor tweak. This is a completely different narrative about the company's profitability.
So that brings us to what might be the single most important question in this entire analysis. What exactly is Thermo Fisher adjusting away to get from that lower GAAP number to the higher non-GAAP number they want you to focus on? What expenses are they basically telling investors, hey, just ignore these, they don't count? We need to pop the hood and see what parts they're taking out to make the engine sound a whole lot better than it actually is.
Okay, so this slide breaks it down. These are the primary adjustments. The biggest one, by far, is something called amortization of intangibles, which comes from all those acquisitions we were just talking about. They also adjust out restructuring costs, one-time transaction costs related to the deals, and other items they consider non-operational. Now, from management's perspective, these things aren't part of the core day-to-day business, so excluding them gives investors a clearer view of the underlying earning power of the company. A clearer view? Or a totally distorted one? Just look at these items. Amortization of acquisition-related assets, restructuring costs, transaction-related costs. These aren't imaginary expenses. They are the very real, very direct costs of their entire buy-growth strategy. They spend billions of dollars on a company, and then they have the nerve to tell us to ignore the cost of integrating it and writing down its assets over time. It's financial engineering, plain and simple. They want all the credit for the revenue they buy, but none of the blame for the costs that come with it. It's like buying a brand new house and telling your spouse not to worry about the mortgage payment because it's not a core living expense. It's just absurd.
And hey, you don't have to take my word for it. This is a direct quote from Thermo Fisher's own financial documents. They themselves are telling you right there in black and white that these adjusted numbers are not a substitute for the real GAAP results. It's a mandatory disclaimer, sure, but it's one every single investor should read and take very, very seriously. When a company spends this much time and energy creating an adjusted reality, you have to be extremely wary of the story they're trying to sell you. They're basically admitting, hey, this is our preferred version of the story, but the official one is over there. You should always read the official one first.
All right, let's move to the last phase of this stress test, capital deployment. In other words, where does the money go? Is management using the enormous amount of cash this business generates to reinforce the fortress for the long term? Or are they just frantically trying to paper over some of the cracks we've been exposing? A company's checkbook reveals its true priorities. So let's follow the money.
As we've already covered, a core part of their strategy is growth through acquisition, and here are some of the big ones from the last few years. Just recently, they closed the deal on a company called Clario, a leader in data for clinical trials. And before that, they announced a deal for Solventum's purification business. Look, these are not small speculative bets. These are big, strategic moves to acquire established revenue streams and proven technology, which bolsters their market leadership and adds billions to their top line. This is building the fortress, brick, by buying market share and strengthening their competitive position.
Now, beyond acquisitions, they are deploying a ton of capital directly back to shareholders. Just look at the scale of their share buyback program. We are talking $3 billion in 2023, $4 billion in 2024, another $3 billion in 2025. This is a massive return of value. What management is effectively saying is that they believe their own stock is a great investment, and they're using company cash to reduce the number of shares out there. And basic math tells you that boosts the earnings per share for everyone who remains an owner. It is a sign of immense financial strength and deep confidence in their own stock.
$13 billion. Let that number sink in. That's the total amount of money they've spent on buybacks from the start of 2023 through the first quarter of 2026. $13 billion. Is that really a sign of confidence, or is it the only lever they have left to pull to make their EPS numbers look good? Just think for a second about what else that money could have been used for. Imagine $13 billion invested in internal research and development to create true breakthrough organic growth, or using it to pay down debt to make the balance sheet an even stronger fortress. To me, it feels less like a return of value and more like a tool to manufacture value. It's a financial tool to prop up a stock price when the underlying business isn't really growing.
But it's not just the buybacks. They're also consistently growing their dividend, and they just announced another 10% hike in the first quarter. Now, a dividend is a cash commitment. You cannot fake it with accounting adjustments. You either have the cash to pay it or you don't. And raising it consistently, especially by double digits, is one of the clearest signals management can possibly send about their confidence in future cash flows. They are promising, in cash, to send more and more money to their shareholders every single year. Cash doesn't lie.
Okay, we've run the numbers, we've stress-tested the foundation, we've followed the money. Now it all comes down to this one question. Is Thermo Fisher a rock-solid opportunity for your portfolio, or is it a carefully constructed trap just waiting for an unwary investor? It's time to deliver the final verdict from Iron Financial.
The bull case is pretty clear, and it's compelling. If you buy TMO, you are investing in a world leader in an absolutely indispensable industry. Their scale and that trusted partner status we talked about, that creates a deep competitive moat. They generate enormous amounts of cash, which management then deploys aggressively through a proven strategy of acquiring growth and returning billions to shareholders through buybacks and dividends. The result of all this is a strong and growing adjusted EPS, which is ultimately what drives the stock price over the long term. This is a financial fortress, built to last, run by a management team that knows how to win.
The bear case, however, sees some very significant cracks in that armor. The true foundation of any great company is organic growth, and at just 1%, Thermo Fisher's is frankly anemic. This has forced them into a heavy dependence on acquisitions just to show any meaningful top-line growth at all. Then, to make the profit numbers look good, they rely on these adjusted earnings that conveniently ignore the very real costs of that acquisition strategy. And finally, they spend tens of billions on buybacks to prop up the EPS. So the critical question a bear has to ask is this: is all this financial activity a sign of strength, or is it just a sophisticated way to mask a core business that has completely stopped growing on its own?
In the end, you have to look at the leadership and their track record. The CEO, Mark Casper, expresses extreme confidence. He points to their very strong performance and their team's execution. So the bull case really rests on the belief that this management team knows exactly what it's doing. They're using their immense financial might to navigate the current environment, acquire strategic assets, and ultimately create value. They're playing the long game, and they've proven in the past that they can deliver.
So here it is. Here is the final takeaway from our entire analysis today. There is no doubt about it. Thermo Fisher is paying for growth. They are buying it through acquisitions, and they are supporting their stock price with massive buybacks.
There's no debating that strategy. The only question that you, as an investor, have to answer for yourself is this: will it pay off in the long run? Can this strategy of buying, integrating, and adjusting continue to create real shareholder value? Or will the cracks in that organic foundation eventually undermine the entire structure? That is the multi-billion-dollar question you have to answer before putting your capital to work. Thanks for joining us at Iron Financial.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.